Good day, and thank you for standing by. Welcome to the Targa Resources Corp. Second Quarter 2026 Earnings Webcast and Presentation. At this time, all participants are in a listen-only mode. After the speaker's presentation, there will be a question-and-answer session. To ask a question during the session, you will need to press star 11 on your telephone. You will then hear an automated message advising your hand is raised. To withdraw your question, please press star 11 again. Please be advised that today's conference is being recorded. I would now like to hand the conference over to your speaker today, Tristan Richardson, Vice President, Investor Relations and Fundamentals. Please go ahead.
Thanks, operator. Good morning, and welcome to the second quarter 2026 earnings call for Targa Resources Corp. The second quarter earnings release, a supplement presentation, and our latest investor presentation are available in the investor section of our website at targaresources.com. Statements made during this call that may include Targa's expectations or predictions should be considered forward-looking statements within the meaning of Section 21E of the Securities Exchange Act of 1934. Actual results could differ materially from those projected in forward-looking statements. For a discussion of factors that could cause actual results to differ, please refer to our latest SEC filings. Our speakers for the call today will be Matt Meloy, Chief Executive Officer, Jen Neal, President, and Will Byers, Chief Financial Officer. Additionally, members of Targa's senior management will be available for Q&A, including Pat McDonie, President, Gathering and Processing, Ben Branstetter, President, Logistics and Transportation, and Bobby Muraro, Chief Commercial Officer. I'll now turn the call over to Matt.
Thanks, Tristan, and good morning. We had another great quarter where we reported numerous financial and operational records. Adjusted EBITDA increased 38% year over year. We reported record volumes again in the Permian, up more than 900 million cubic feet per day from a year ago, and up 450 million cubic feet per day compared to Q1. That's almost 2 plants worth of gas in one quarter. This strong Permian growth drove record volumes across our downstream systems, including NGL transportation, fractionation, and LPG export. Our customers remain active, and the commercial service offering we've built the past many years continues to gain traction with our customers. We continue to benefit from the activity of our producer customers with millions of acres dedicated across the Permian, and that number continues to grow. With the largest GMP footprint in the Permian, we believe we are positioned very well for continued growth over the long term. And given the strength we have seen so far this year, we now expect to be towards the top end of our previously provided adjusted EBITDA guidance range, suggesting that our 2026 adjusted EBITDA growth over 2025 may be close to $1 billion, all while reducing our share count and increasing our dividends. This strong performance underscores the value of the organic growth projects that we continue to invest in and positions Targa for success across a range of market conditions. In the first half of 2026, against a backdrop of weather-related challenges in the first quarter, natural gas takeaway constraints, negative Permian gas pricing, and broader market volatility, we were still able to deliver record results. And beyond 2026, we believe we are in an excellent position with our multiple projects underway, expected to provide our producer customers with the critical infrastructure needed to grow production. And the global environment is recognizing the value and importance of U.S. energy now more than ever. We expect to benefit from critical long lead demand catalysts, including expanding LNG export capacity, growing power generation needs, increasing global demand for hydrocarbons, and increasing recognition of the strategic role U.S. energy plays in supporting economic growth and energy security worldwide. Against this backdrop, we believe Targa is uniquely positioned to benefit from sustained producer activity and increasing demand for the critical infrastructure services we provide. Our focus at Targa remains unchanged: to deliver the very best operating performance for our customers, to utilize that track record to continue to add contracts with existing and new customers, and to deliver on our major projects currently underway. We believe our premier Permian asset footprint, integrated wellhead-to-water system, and strong financial position provide a durable competitive advantage. These strengths allow us to continue investing in high-return integrated growth opportunities that maximize the value of our existing network while supporting our customers' development plans. Before I turn the call over to Jen to discuss operations in more detail, I would like to thank the Targa team for their continued focus on safety and execution while continuing to provide best-in-class service and reliability to our customers.
Thanks, Matt. Good morning, everyone. Second quarter Permian volumes were a record 7.2 billion cubic feet per day, up approximately 7% from the first quarter and 14% from a year ago. We mentioned in early May that we had about 200 to 400 million cubic feet per day of gas shut in behind our Permian systems on any given day with weak Waha prices, so our volume growth of 450 million cubic feet a day quarter over quarter, despite a second quarter with shut-ins, demonstrates the robust activity that we are seeing on our assets. With Hugh Brinson Phase 1 and the GCX expansion now online, we have seen most of the price-driven producer shut-ins return to our system in July, and we continue to see a lot of activity behind our systems, positioning us really well for strong growth in Permian volumes across 2026 that are tracking higher than what we were expecting in February. This will position us well with continued momentum heading into 2027. The constrained gas egress environment across the past several quarters has created increased marketing opportunities for Targa, with our marketing businesses outperforming our expectations by approximately $250 million in the first half of the year, much of which occurred in the second quarter. Waha gas prices have improved, narrowing basis spreads, and curtailed volumes are returning to our system, highlighting some of the built-in offsets in our business. In addition to the strong growth we are seeing from our customers, 2026 is a year of significant execution for Targa as we continue to progress the major projects along our integrated system. In the Permian Delaware, our 5 gas processing plants, Copperhead 1 and 2, Yeti 1 and 2, and Roadrunner 3 are on track to begin operations as previously announced. In the Permian Midland, our East Driver plant began service late in the second quarter, ahead of schedule. We continue to see growth behind our Midland system and are currently evaluating the timing of our next Midland processing plant. We also continue to execute on our residue natural gas strategy, adding intrabasin connectivity across our Permian footprint with our key natural gas projects on track, which will enhance our producer customers' access to multiple premium markets. Blackcomb and Traverse, 2 natural gas pipelines in which we have an equity interest, remain on track for the fourth quarter of 2026 and mid-2027, contributing to continued improving natural gas egress in the Permian for the near to medium term. Shifting to logistics and transportation, the growth we are experiencing in the Permian is flowing through our integrated footprint, contributing to record NGL transportation volumes of 1.1 million barrels per day and record fractionation volumes of 1.2 million barrels per day. With conflict in the Middle East increasing global demand for U.S. hydrocarbons, our LPG export loadings averaged a record 14.8 million barrels per month during the second quarter. The Targa team was able to respond quickly and serve our customers, and our commercial teams have been active adding to our long-term contract portfolio. With our strong outlook for continued growth on our Permian G&P footprint, which we expect will create meaningful incremental supply of NGLs, we have several key downstream projects underway. Our Train 11 and Fractionator came online early in the second quarter and was quickly highly utilized, and our Train 12 and Train 13 fractionators remain on track. Targa's Delaware Express pipeline, an expansion of our NGL pipeline transportation system within the Permian, came online during the second quarter and will give us much-needed capacity for the growing supply of NGLs we are seeing across the Delaware Basin. Speedway, the large expansion of our NGL transportation system connecting our Permian G&P position to our leading fractionation footprint in Mont Belvieu, remains on track for the third quarter of 2027. Our NGL transportation system has effectively been running full since we announced Speedway, and our transportation volumes reflect our proactive and capital-efficient efforts to secure medium-term transportation agreements on third-party pipelines until Speedway comes into service. We have completed 5 processing plants in the Permian since we announced Speedway and have 5 plants currently underway. The growth we expect from our G&P footprint positions us well for a baseload of supply for Speedway's initial capacity of 500,000 barrels per day. Lastly, we expect our large LPG export expansion that will increase our capacity to around 19 million barrels per month will be much needed and remains on track for the third quarter of 2027. We believe that we are exceptionally well-positioned operationally and that our wellhead-to-water strategy, driven by activity in the Permian Basin, will continue to put us in excellent position to execute for our shareholders and customers. I would also like to thank our employees that have worked tirelessly to continue to perform safely and at an exceptional level for our customers and our shareholders. I will now turn the call over to Will to discuss our financial results and outlook in more detail. Will?
Thanks, Jen. Targa's reported adjusted EBITDA for the second quarter was $1.603 billion, 14% higher than the first quarter. The increase was primarily a result of contributions from higher optimization opportunities in our marketing businesses and record volumes across our operations, including Permian GMP, NGL transportation, fractionation, and LPG export. Given the strength of our performance so far this year, we now expect full year 2026 adjusted EBITDA to be towards the top end of our guidance range of $5.7 to $5.9 billion. As has long been our practice, we do not forecast material marketing optimization margin when we provide our financial expectations. The first half of 2026 benefited from marketing opportunities that were not included in our guidance provided in February, and our approach remains unchanged as we look to the balance of the year. Importantly, the fundamentals supporting our business are very constructive. Improved Permian takeaway capacity and stronger Waha pricing are benefiting our customers and supporting continued growth in liquids-rich natural gas volumes across our integrated system. Combined with the ongoing execution of our growth projects and the strength of our asset footprint, these factors continue to support our confidence in the outlook for the second half of 2026 and beyond. We continue to estimate net growth capital for 2026 of approximately $4.5 billion. We also continue to estimate 2026 net maintenance capital spending of $250 million. At the end of the second quarter, we had $3.2 billion of available liquidity, and our pro forma consolidated leverage ratio was approximately 3.4 times, well within our long-term leverage ratio target range of 3 to 4 times. In July, we also extended the maturity of our accounts receivable securitization facility to July 30th, 2027, and expanded the total capacity by $200 million. Shifting to capital allocation, our focus is more of the same from Targa: maintain our strong investment-grade balance sheet, continue to invest in high-returning integrated projects, and return an increasing amount of capital to our shareholders. We declared a second quarter common dividend of $1.25 per share, which is a 25% increase relative to the second quarter common dividend for 2025. We also opportunistically repurchased approximately $80 million in common stock at an average price of $259.93 per share during the second quarter. We are on track for another record year at Targa across multiple dimensions and remain well-positioned to create value for our shareholders over the long term. And with that, I will turn the call back over to Tristan.
Thanks, Will. For the Q&A session, we ask that you limit to one question and one follow-up, and re-enter the queue if you have additional questions. Operator?
As a reminder, to ask a question, please press star 11 on your telephone and wait for your name to be announced. To withdraw your question, please press star 11 again. Please stand by while we compile the Q&A roster. Our first question comes from Jeremy Tonet with J.P. Morgan Securities. Your line is open.
Hi, good morning.
Morning, Jeremy.
Morning.
Just wanted to touch on how you see the volume trajectory at this point. If you could drill in on what type of curtailment you see on the system and, what could come back over, I guess, the balance of the year. And just thinking, I guess, some of your competitors say that they're seeing, activity picking up, quicker than they expected. And I'm wondering, how you see activity in your system and the trajectory into 27.
Morning, Jeremy. This is Jen. I think as I tried to describe in my scripted remarks, volume growth is going really, really well across the Targa system. We had a really good start to the first half of the year which is pretty remarkable when you think about the weather impacts in the first quarter, and then, as we described on our May earnings call, about 200 to 400 million a day of shut-ins on any given day during the second quarter. So to have 450 million cubic feet a day of growth quarter over quarter, I think is really reflective of the producers and the activity in and around our systems. As we look forward, July was another really strong month of volume growth. So as I said, for the year now, I'd say that we're tracking ahead of expectations with a view of continued volume growth across the back half of the year. I think largely the growth that we're seeing is consistent with what we expected. Again, maybe a little bit ahead, but we've got really active producers across the system that I think are feeling supported by a macro backdrop now with both higher crude oil prices and now with the egress situation in the Permian at least temporarily resolved, benefiting from higher gas prices. So it's just a really supportive environment of both an expectation for continued activity back half of 26, and then that, of course, I think means we're well supported for continued growth into 27 and beyond.
Got it. Thank you for that. And then just wanted to go back, I guess, to, any thoughts you could share on the cadence of gas processing plant additions, how you see that going forward each year. Is it 3 a year? Would you expect 3 for 28? Or how should we, think about that at this point?
I think you've seen a quick cadence of plant adds for us over the last several years. Here already this year, getting 2 plants online in the Midland Basin. That's a little bit lumpier for us, having 2 plants come online as quickly, sort of back to back as they did. But part of that was an exceptional job by our engineering and operations team to get East Pembroke online earlier than expected. We've now got 5 plants that are under construction. Indicated on the call this morning that we're evaluating the appropriate time to move forward with our next Midland plant. So as we look forward, we put out an illustrative framework now a couple of quarters ago that demonstrated, continued cadence of, call it 3 plants a year if we assumed high single-digit, low double-digit Permian growth. I think where we are today with the commercial success that we've had over the last couple of years is accelerated from there. Ultimately, whether that cadence continues to be accelerated going forward will be a function both of the existing contracts that we've already got in place as well as continued commercial success. I'm biased, but I think we've got by far the best commercial team in the business, and I can assure you that they are not resting on their laurels and are continuing to go out and identify new opportunities to add to the contracts that we already have in place with existing and new producers. So we'll be continuing to work that angle as well. So I think we just feel really good, Jeremy, but ultimately the pace of growth will drive, is it 3 plants, is it more plants, but feel really well positioned for just continued growth going forward.
That's really great to hear. Thank you.
Thank you.
Thank you. Our next question comes from Spiro Dounis with Citi. Your line is open.
Thank you, operator. Morning, team. Jim, I want to go back to your comments around the integrated footprint. If I include East Driver, that's about 6 announced plants, adding about 240,000 barrels a day of NGL to the system. It sounds like you're covered on the egress side. Frac arguably starting to look a little tight again if you announce another plant. And then on export, I think that's probably where we could see the need for another expansion sooner rather than later. So curious how you're thinking about downstream infrastructure needs and what a 7th or 8th plant coming online in 2028 might do to the need to expand downstream again.
Morning, Spiro. I think we've got really good operating leverage when we think about Speedway coming online in the third quarter of 2027 and our ability to expand Speedway from, call it 500,000 barrels a day to 1 million barrels a day by just adding incremental pumps as our volume growth continues to ramp. Very cost-efficient way to add a lot of capacity. So I think we've got good operating leverage there, but are in a really good spot to base load Speedway with a lot of volumes given everything that we've announced since that came into service. And as you pointed out on the LPG export side, a lot of operating leverage there when that expansion comes online in the third quarter of 2027 as well. So I think you really hit all the key points, which is we need to evaluate the timing of our next fractionator. Feel like we're in good position right now with train 11 online, highly utilized from startup. Feel like trains 12 and 13 will be as well, but we'll evaluate the right timing of that next frac. Otherwise, on the residue side, feel like we're in a good spot with all the intrabasin activity that we've got underway to really build out our residue capabilities. So ultimately, I think it'll continue to be more of the same, which is with the additional plant adds, when do we need another frac? But we do have, I think, material operating leverage across both NGL and transportation and exports once we get those two big projects online in third quarter 2027.
Got it. That's great to hear. Maybe just go back to the guidance quickly, and you talked about this a little bit with Jeremy, but it does seem to imply a decline in the second half of the year to hit the high end, which does scream conservative to us. Certainly appreciate the point that Waha marketing gains are probably moderating here, but you had a lot of positive commentary about producer activity and curtailments really coming back, and would have thought that'd been enough to offset. Could you maybe just walk through some of the assumptions and maybe put a finer point on what you're not counting on that could lead to a positive surprise?
Yeah, hey, Spiro, Matt here. No, good question. Look, the first half of the year was really strong underlying volume performance, which Jen talked about, but we also pointed to $250 million of optimization margin that we weren't counting on. And with the basis narrowing, part of that margin, comes from our transport position. So we forecast that pretty conservative in the back half of the year. We don't have a very significant assumption for continued marketing gains as we go forward from here. And so that's why you're saying, perhaps a conservative view of the second half of this year. But with the volumes that we've seen across our system, Jen talked about the strength that we've had so far this year. Most of the shut-ins have returned. July was a really good month. We've had really good August so far, and we actually still have some volume shut in on our system. They're going to come back and add even more volumes in the back half of the year. So I think we feel really good about the underlying volume trajectory. It's just going to be moderated and offset by perhaps lower marketing opportunities in the back half of the year.
Got it. Appreciate the color, Matt. That's it for me today. Thank you, everyone.
Okay, thank you.
Thanks, Spiro.
Thank you. Our next question comes from Jackie Koletas with Goldman Sachs. Your line is open.
Hi, good morning. Thank you so much for the time. First, just wanted to touch again on kind of the NGL business and extending your platform. Peers are actively expanding the ethane export capacity on the Gulf Coast. I mean, where would you say are the economics currently for expanding into ethane capacity at Galena Park? Are you comfortable continuing to rely on the LPG business, or is there a scale that you can see on ethane export solution?
Good morning, Jackie. This is Jen. I think it was probably, 8 or 9 years ago that we first mentioned publicly that we were evaluating ethane export opportunities. Given the vast amount of ethane in our system, I think it puts us in a really good position with a lot of supply. We've managed that supply position thus far by selling into the domestic markets and have really strong relationships with our domestic customers and also with some of our peers that are exporting some of those volumes to the rest of the world. I think that's worked really well for us thus far, but of course we're always evaluating opportunities across the entire value chain, and ethane exports is no different. We've got a growing supply portfolio as a result of all of our gathering and processing plant adds and then the incremental fracs bringing more ethane into our system. I think our team's done a great job of increasing our domestic connectivity to make sure that we're very comfortable with where those volumes ultimately will find a home. But certainly that's something that we continue to evaluate, and we'll continue to evaluate it going forward. But I don't think we feel like it's something that we have to do. I think if it's complementary to what we do and if it makes sense and if it can provide returns that are commensurate with where we can invest across the rest of our portfolio, then we'll certainly continue to consider expanding.
That's very clear. And then just as a follow-up, you mentioned very strong volume recovery. As we see volume growth continue and prices begin to rebound, how do you contemplate the ability to move off the fee floors into 27 and how that may frame up your long-term outlook from here?
I think moving off of fee floors would be very much welcome across the Targa system. We've been below fee floors for a long time, really only having maybe less than a handful of months over the last couple of years where we have benefited from margin above fee floor levels. I think certainly with the incremental egress on the natural gas side, you're seeing gas prices move higher. Our fee floors are a combination of both gas and NGL prices, so ultimately it will depend where sort of the entire barrel moves. But I think that from our perspective, we do believe with all of the tailwinds around the incremental demand for natural gas and NGLs in the U.S. and globally, we're likely to see some price tailwinds as we move forward. And ultimately that would be certainly additive to our performance as we move through the next several years.
I'll leave it there. Thank you.
Thank you.
Thank you.
Thank you. Our next question comes from Julien Dumoulin-Smith with Jefferies. Your line is open.
Hey, good morning, team. Thank you guys so much for the time. Appreciate it. Maybe following up on what's been discussed here a little bit, can you follow up on the plant cadence? Can you speak to what are the variables that can surprise the upside to this 3 plant per year model, right? Is it more the Permian macro versus specific commercial wins? And specifically, given the commercial discussion that you've had here in 25 and obviously year-to-date 26, are you tracking ahead of that expectation of 3 plants per year, or that framework for 28 and onwards here? Again, kind of going on your improving backdrop commentary.
Yeah, no, good question. And we're always, challenging ourselves for what, how to kind of think about that. I think it's a combination of what you talked about. I think overall just trends in the Permian Basin with just strong activity, increasing GORs is going to put us in good position to continue to add multiple plants a year for years to come. But then on top of that, which is a bit more episodic, is our larger commercial wins and other opportunities. And as Jen said, we think we have the best commercial team in the business. So as we continue to have commercial wins, you've seen us talk about that in 2024 and 2025. We're having a good year so far in 2026 and would expect to continue to add more acreage dedications, more volumes from our commercial success. So I think in any environment, we're going to be adding multiple plants a year. I think that is, already outlined, and we have 5 plants coming on, and already announced, and we're evaluating the timing of the next plant in the Midland, and we're evaluating more plants in the Delaware for, future timing. So we feel really good about adding, significant volumes, but I think it's a combination of all of those factors.
Awesome. And maybe a related point here. With the Permian Basin continue to consolidate, can you speak to how you're structuring your commercial strategy going forward, right? Are you pursuing a more volumetric-centric strategy on the G&P front to attract more volume on your system and improve more of a system-wide ROIC with your downstream assets, if you will? I mean, how are you thinking about that, especially given the improving volume writ large we just alluded to?
I think that we have exceptional relationships with our producers and are always trying to add to our portfolio of producers that we have on our systems, Julian. And so part of what we pride ourselves is a willingness to be creative and work with each individual producer to meet their needs, whether that's a result of the needs that they have from consolidation or for any other reason. So for us, it's a portfolio approach. We work with each individual producer to try to figure out what their needs are and then best meet those needs. And then that all comes together in thinking through what, therefore, that we need from an infrastructure perspective to support that outlook of growth that portfolio of producer customers will provide for us. So I think it's really much each producer is different. We work very well with each of the producer customers that we have, are always trying to figure out how to best position our producer customers for success as well as Targa. And that's really, I think, put us in a really good position to both continue to service existing customers and add contracts with existing customers and then go out and win new business as well.
Okay, fair enough. Thank you guys very much. Congrats.
All right, thank you.
Thank you. Our next question comes from Gabriel Marie with Mizuho. Your line is open.
Hey, good morning, team. I had a quick question on LPG exports. With all the volume you were able to squeeze out during the quarter, and I think some of the co-loading you mentioned with butane allowing you additional capacity, has that mean that the excess capacity become underwritable under long-term contracts? And then maybe you can speak a little bit to some of the new contracts you're signing, tenor, pricing, just directionally speaking. Thank you.
Hey, Gabriel. This is Ben. Yeah, you hit on it. We had a great second quarter on the export side. I'd like to say thanks to our internal team who really worked hand in hand with our customers to utilize every minute of dock space that we could and get product out to the world. You also hit on part of the record was us being able to load more butane given the global demand for butane. So that did help us move some additional volume across the dock in the second quarter. As we've looked forward, we came into the second quarter highly contracted. We remain highly contracted. We're contracted through LEP4 startup and for years thereafter. And part of that has been the current environment that's been very strong. We came into this year with a lot of really good discussions underway. Those have only improved with the conflict. We're seeing people that weren't necessarily targeting U.S. supply now targeting U.S. supply. And so we have been able to underwrite some of this current environment into our long-term outlook for our exports.
Yeah, and just to add on to that too, with the increased demand for butane across our dock, we are working into more of our longer-term contracts, more butane loadings contracted as opposed to having that open capacity. So it's been nice on that front as well.
Great, thank you.
Okay, thanks, guys.
Thank you. Our next question comes from Manav Gupta with UBS. Your line is open.
Good morning. Congrats on a great quarter. I just wanted to understand, can you help us with the post-Speedway material inflection in free cash flow? So how should we think about those incremental usage of those incremental free cash flows once Speedway does come online?
Good morning, Manav. This is Jen. I think that for us, it's going to continue to be really the approach that we've taken over the last several years, which is we'll continue to invest in the business. We'll materially increase our common dividends per share. We'll opportunistically repurchase stock, and we'll have a really strong to strengthening balance sheet. I think we're really excited about that inflection when you think about Speedway and our LPG export facility coming online in the third quarter of 2027, which will finally sort of put us in a position to offer our shareholders and prospective shareholders a value proposition that has a really attractive growing EBITDA business and sort of underlying fundamental operational position combined with also an increasing free cash flow position too. So I think that's a spot that we're really excited about getting to, but it's really a function of our continued investment in our business has created opportunities for us to grow our EBITDA to the point where we will be able to both invest in our business and have free cash flow. And that inflection is really what is going to occur when we get Speedway and our LPG export facility online.
Perfect. My quick follow-up here is a little bit, on the last earnings call, Exxon talked about 40 different technologies that they're deploying in Permian, and they're basically saying those are stackable. And what they say is it will materially improve recovery within the Permian. And Chevron, through its advanced chemicals, is saying they're seeing material decline in terms of rates when they deploy these chemicals. So I'm trying to understand, besides the price and other things, do you see technology driving significantly higher Permian volumes? Because once Exxon and Chevron catch on to it, others would also. So trying to understand, are you seeing anything out there in technological perspective which could drive higher Permian recovery, which would benefit you guys? Thank you.
Manav, I think that the producers are the best sources of information around the technologies that they're using and the results that they are driving through those technological improvements. I think we certainly have a view that, as we've seen over the last couple of decades, technology will continue to drive improving results and efficiencies for our producer customers, and we'll be a big beneficiary of that. I think there's a lot of talk about helpful technologies now and expected into the future, and that will provide an incremental tailwind for us. So I think there's a lot of reasons that we feel very convicted about our opportunities to grow our volumes as we look out over the next short, medium, and long term. Technology is probably a smaller part of that, but it'll certainly be a nice to have as our producers continue to make technological improvements.
Thank you so much.
Thank you.
Thank you. Our next question comes from Bert Sanseviero with Wolfe Research. Your line is open.
Hi, good morning. Just one quick one for me today. So GMP volumes were up 7% quarter over quarter, and then gross margins were up 4%. So per unit margins went down. Any color around what pushed that per unit margin lower, and where should we see it trend from here? Thank you.
Yeah, I can start. I mean, we have done a really good job at moving our GMP contracts to fee-based contracts. That said, we still have some part of our GMP contracts that are commodity sensitive, and so that was a slight headwind. And then there are, gains, fuel gains, fixed recovery gains, some other gains which, can affect results as well. But overall, Really strong quarter for our GMP, but I'd say it's largely commodity price, which was a slight offset to our GMP business in the quarter.
Thank you.
Thank you.
Thank you. Our next question comes from Jason Gabelman with TD Cowen. Your line is open.
Yeah, hey, thanks for taking my questions. I was hoping you could elaborate on a couple points that have already been touched on. First, on the processing plant growth, it seems like the lead time from sanctioning to starting up is somewhere between 20 to 24 months. Is that still what you're seeing, and how are you managing some of the pressure points in the supply chain?
This is Pat. Yeah, lead times definitely have gotten extended, and a lot of it is around the electrical infrastructure for plant. It's some of the vessels that are needed for the plant build. But frankly, we've adapted to that. We have good line of sight on our volume growth. I'd say it's more like 18 to 24 months is kind of the time frame that we look at. Construction, part of that is really 10 to 12 months, depending upon is it sweet, sour, is require an AGI well, et cetera. But frankly, lead times on compression, lead times on certain components of plants certainly are extended, but it hasn't affected our ability to perform in any way.
Great, that's helpful. And then my follow-up is just, I want to understand a bit more the kind of trade-off between the lower marketing margins and then the improvement on Waha prices as it feeds through your fee floors. And I know you've been hesitant to kind of provide any guidance on what commodity price levels result in an increase of fee floors. But just as we sit here where prices are right now, would you expect the net impact from lower marketing margins in 3Q to be offset by an uplift in fee floors, or is that a net tailwind or headwind based on where commodity prices sit right now versus 2Q? Thanks.
Good morning, Jason. I'd say that that'll be a headwind for us third quarter versus second quarter in terms of just the strength of marketing benefits that we had in the second quarter. It wasn't just on the natural gas side with Waha. As Ben talked about, we also had very strong LPG export marketing benefits in the second quarter, which helped us too. So as we think about the third quarter, I think the biggest beneficiary of higher Waha prices will be our producers, which ultimately puts us in the best possible position. We like when our producers are incentivized to continue to be active, and I think with higher crude prices along with higher gas prices, there's a really supportive macro backdrop for our producer customers. But for us, I think we will continue to likely be below fee floor levels, sort of in the aggregate across the portfolio in the third quarter. We do have an expectation that gas prices will continue to potentially increase with the demand pull that we are seeing for volumes out of the Permian, and that'll be a tailwind over time for us.
Great. Thanks for the color.
Thank you.
Thank you.
Thank you. And our final question comes from Sunil Sibal with Seaport Global. Your line is open.
Yeah, hi, good morning, and thanks for all the color on the call. So first, a clarification. I think you suggested that you're still seeing some shut-ins in volumes in Permian. So just wanted to clarify, is that primarily price-related, or are there any other issues which might be causing that?
Good morning, Sunil. I'd say that we generally have shut-ins across our assets when producers are shutting in volumes for frac protection and things like that. So I'd say that where we are right now in early August, the vast majority of what I'd call price-related shut-ins are back on our system. We've got a little bit that's still coming back on that'll provide a little bit more of a tailwind for us here in the third quarter, but I'd say the vast majority are back online now.
Okay, thanks. And then on the gas egress side, I think you touched upon a couple of projects in which you are participant, kicking in late in 26 and 27. So I was curious, when you think about the base earnings, which you talked about from your gas marketing business, should we expect that base earnings also to move up as those projects come online, or is that all capacity that will essentially help you move on the G&P side of things and is all talked about there, or taken care of there, I mean?
We will benefit in terms of our equity earnings as a result of the 17.5% interest that we have in those projects, benefiting from higher equity earnings when those projects come online. In terms of the gas marketing business, that's really where the margin that's reported there is related to our ability to utilize our vast network of infrastructure in place to move volumes to different markets on behalf of our producers and Targa. So a little bit apples to oranges. So I think in terms of the projects coming online that I talked about with Blackcomb and Traverse, there we've got a 17.5% equity interest, and certainly will be a beneficiary when those projects are online and have ramped fully. And then on the gas marketing side, ultimately, the forward performance will depend on what we see as opportunities in the market. And I think we've had a really strong last several years related to gas marketing. I think we've hopefully demonstrated that we've done a good job of managing the risks across our enterprise such that if Waha gas prices are low, our infrastructure allows us to potentially be a beneficiary of that type of environment. We have an expectation that gas may get tight again in the future, so we would have those assets in place to be a beneficiary there. Otherwise, we're always trying to figure out how to move gas to higher price markets and utilize our assets to do so, and our gas marketing team does a really good job of that quarter in and quarter out. I think what we are just trying to highlight is that the last several quarters, and second quarter in particular, there was material outperformance as a result of the dynamics that we were seeing in the market.
Yeah, thanks for that. If I can ask a clarification, seems like, one of your customers recently announced a big behind-the-meter power generation project in Permian to support the data center demand. Is that something that you're seeing, more widespread in your operations, and how does that impact your strategy on the gas marketing side?
Yeah, sure. No, there's multiple projects out there to support data centers and other needs for gas for power generation. And so we're actually in our gas marketing team having conversations about potentially being a supply for some projects in and around the Permian. We continue to have discussions, and I'd say that is somewhat of an opportunity for us. We think multiple projects like the one you referenced and others are likely to get done and be some additional demand for gas in the region.
Thanks, Matt.
Okay, thank you.
Thank you. This concludes the question and answer session. I would now like to turn it back to Tristan Richardson for closing remarks.
Great. Thanks to everyone for joining the call this morning, and we appreciate your interest in Targa Resources.
This concludes today's conference call. Thank you for participating. You may now disconnect.